Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Dan Monzani, and I'm Aurora's Managing Director with responsibility, amongst other things, for our new service in India. Today is our second of our interviews, exploring the growing opportunities in India. Having discussed India from a regulatory perspective with Suman Berry in our 200th episode, today we turn to project finance. And we're extremely fortunate to have one of the most forward-thinking and thoughtful finance leaders in the sector with us. He is Chief Executive and Chief Country Officer of Société Générale in India, with responsibility for supervising SocGen's global banking and investor solutions activities in India. He has more than 2 decades of experience globally, including as co-head of advisory and project finance for EMEA in London, in responsibility for the largest ever project financing in Africa, and before that with BG Group in Brazil, Tunisia, Iran, and the UK. My guest today is Katan Hirachand. Katan, how are you? Welcome to Energy Unplugged.
Hi, Dan. Thanks for having me. Obviously, very, very happy to be here and tell you more about the journey that I've been on.
Well, that's fantastic. Let's start there, shall we? So you've had a really interesting career journey across several continents, financing all sorts of things, including energy projects, both conventional and renewables. Tell us a bit about your journey and what the different types of risk you've dealt with. What's the main challenge for international lenders in the energy sector across those different non-OECD countries?
Yeah, it's a very pertinent question, and one that is always at the forefront when it comes to playing the role of financial advisor, as we have done on a number of projects. Clearly, a financial advisor has to be very forward thinking, simply because you are raising long-term money that has to effectively sort of withstand, the crystal ball gazing as to how a given sector may, evolve. I would say in sort of non-OECD jurisdictions, Dan, political risk has to be right up there as one of the key challenges, and that takes multiple forms. In its pure essence, we're really just talking about the stability, in terms of the government, and obviously a corollary of that is government policy. So whether you're developing an LNG project in Africa, whether you're doing a refinery project in Latin America, really what is the approach and what is the policy that the government is putting in place? Clearly, as evidence through our experience, these projects tend to be very large. We talk about projects, but the reality is that there are multiple projects within one overall project, which is designed to effectively deliver a certain product into a market or set of markets over an extended period of time. So I think, coming back to the essence of your question, I think looking at the political stability, the consistency and continuity of policy, ensuring that what you're doing, especially in an advisory capacity, is cultivating a win-win, whereby for countries that are on the developing side of the spectrum, they obviously have their needs, whether it's knowledge transfer, whether it's technology transfer. All of these things absolutely have to be taken care of in the overall tapestry of the project that we will be assisting our clients to pull together and ultimately take to market.
What's the role within those risks for you as a private sector lender to work with partners in public sector finance, if you like, either things like JETP, sort of development funding, or the World Bank's IFC as a public sector lender? How do you partner with those in the different markets in which you've operated?
Yeah. So firstly, they are a crucial participant in terms of being able to ultimately unlock the investment for the debt raising part of it. They actually play quite an important role in the equity as well, but although the equity may be a little bit more of a halo impact, which is effectively a benefit that is induced by their presence. Scale often necessitates, Dan, in these situations, the need to go for what we call, in project financing speak, multi-sourced financing. Now, multi-source financing would be something that could involve some of the the two names you mentioned, i.e. the multilaterals, along with other development banks, along with people like export credit agencies who are obviously there to promote exports from their country. Then you're talking about international banks like ourselves. You could have regional and local lenders as well. So very quickly, you can see I'm painting a picture of a tapestry that involves different set of lenders, and in some cases, they will have different requirements. Generally, because someone like the World Bank, and you mentioned specifically the private sector developer in terms of the support the IFC provides, there can be people like European Investment Bank, African Development Bank, who are much broader stakeholders in the country. And in the case of Africa, often the country is actually a shareholder of that multilateral institution. So straight away you are cultivating an alignment of interest. And if I come to the fundamentals of project finance, what do people want? What do lenders want? They want as much certainty as possible that the project is going to be built on time to a certain specification and operate as has been labeled on the tin, that it's basically going to meet these specifications, and it's going to often it will need to operate beyond the life of the debt. I think in virtually all cases I've seen that has been the case. So what do you want? You want the certainty. So from a policy standpoint, and really what this then boils down to is the topic of contract sanctity, right? Because how do you get certainty? You get certainty from a long-term offtake, right? That effectively gives you a destination in terms of where the volume is going. It will give a price. That price could either be a fixed price or it could be a market-related price that will fluctuate, and it will fluctuate based on the underlying commodity. But lenders want certainty, is really what they want. And by coming back to your question on what the role of people like the multilaterals is, they actually play a very important role in ensuring the political stability, to ensure or certainly help to ensure that the government will fulfill and discharge its obligations under various contracts. So they can be things like concession contracts mainly, where they are a counterparty and are obviously giving a concession to the sponsor or developer, as they're called, to effectively develop that project over a length of period, which will be the concession life. So the multilaterals can play quite an important role in mitigating a lot of the political risk that is associated with that. And clearly, if you're looking at something that is going to span over 20 years, including, say, the construction period, you are going to have changes in government in that period, right? That's, in most places that would be fairly inevitable. So you want to have the continuity to say, well, look, this project continues to make sense and will continue to honor its obligations as stated in each of the project agreements, and honor that contractual framework. So the multilaterals do play a very important role in effectively ensuring that stability. And coming back to the earlier phrase I used, they also play a crucial role in ensuring that contract sanctity.
Which brings us, I think, to India. Tell us why you personally chose to come to India now, and perhaps you could also give us a brief introduction to what SocGen does in India at the moment.
Sure. So, I mean, it's a good question. I've been on the ground here in Mumbai for the past year now. Moving here definitely represents both, a significant professional as well as personal challenge, because, I moved my family, as well. In essence, have been doing what I was doing prior to that for a significant period of time. As you pointed out at the start, leading the project financing platform for the bank covering Europe, Middle East, and Africa. I ended up doing the bulk of my activity, in Africa, and really had got to a very significant, maturity stage. India for me just represented an opportunity that is somewhat unparalleled in terms of the size, the scale of what is happening here. I guess it very much resonates with what Aurora is doing as well, in terms of firmly establishing its presence here. I think there was an additional connect for me, being sort of second generation. I was born and raised in the UK, but always maintained a good cultural connect in India. So that was also something where I thought, I've always, throughout my career, I've always taken full cognizance of the fact that you really do need to understand local business culture, the way that things are done in different countries. You highlighted the places that I've been based through my career. That was, to be honest, that was one of the biggest thrills and one of the biggest opportunities to really put yourself in other people's shoes, to understand how those things are done. And I thought here, given the cultural connect that I had growing up, that would certainly give me, a little bit of a head start in terms of, the India development. Then you basically sort of overlay the business opportunity here, which I'm really happy to say it resonates quite strongly with where we're going as a bank globally. So if you look at some of the advances that you're seeing in India, I mean, compared to the India that I used to visit as a kid, it has come on leaps and bounds. So in areas, for example, like digitalization, I mean, it's now incredible, that you can go to the fruit trader on the street and literally just flash your phone in order to effect payment. So it's from that level all the way up to the major organizations and the major corporates. Then the other theme, which is obviously very relevant for me, given my own background, is obviously decarbonization. So it just feels, and not just feels, having been here a year, I can say with confidence it is an immense opportunity. And I've really just, I think in this past 12 months, really just trying to catalyze our presence, bringing the DNA strength of the bank in terms of energy sector knowledge, in terms of our structuring skills, in terms of our global network, where we've got a very good feel of what investors are interested in, what type of risk profile. All of these elements were aspects of my consideration. And I think, I must add here that, moving from an originator and effectively a transactor, to a head of country role was always going to be a major challenge. But I feel I'm sort of getting the best of both worlds, really, in this opportunity. Again, just because the opportunity set in India is so immense. And then you were asking me about, obviously, SocGen's presence in India. We've been in India for more than 40 years now. We set up in 1978. So we operate through branches in Mumbai and also in New Delhi. We've supported a number of the Indian corporates, also financial institutions, and also some of our global clients, because as we know, India has really seen a huge boom. And I think, a lot of people prior to coming here told me it's very much going to be India's decade. And I think since I've arrived, I can bear testament, to that, given again the speed of development, the scale of development as well. And if I just connect that to the themes that we're focused on the bank, we've obviously had a significant history in terms of being able to shape, support, and finance the energy transition. Something that we're very much at the forefront of, being able to raise long-term capital, deploy those funds into green projects around the world, at scale. The bank is acutely aware of the decarbonization challenge and the sheer magnitude of that challenge, which is why we take the approach of addressing this sort of collectively with our clients. And specifically there, I think, we're really looking to try and accelerate the transition, as much as possible. And you'll see that in a number of the commitments that have been made, at a global level by the bank. And I think, we've played a very significant role in developing that part, of the economy.
Yeah, I think that very much resonates with what we're doing in India as well. It's both a huge opportunity and an important thing from a values-driven point of view. If you believe in the energy transition, you've kind of got to help accelerate the transition in India, haven't you? It's just so large, such a large part of it. I thought I might just probe in a bit on some of that and the opportunity that you see for a lending bank in particular. Obviously, India has a lot of quite prominent state lenders, State Bank of India and so on, and many of them doing excellent work. What do you think explains why they are so prominent? And do you see that dominance changing as more private finance needs to come into to financing the energy transition?
Yeah, I think that's a good point. I think a lot of the state lenders clearly been present in the Indian market for a significant period of time. They've developed a good understanding of the various sectors. What you see is quite a strong presence right across market participants. These lenders also have very significant balance sheets as well that can be used to mobilize significant amounts through can take an underwriting guise, or it can take just funding sort of various participations as well. So look, all in all, I think they're very important providers of liquidity to the sector, and they can represent a strong competition for the likes of us as international banks. But the reality of India is that the market opportunity is so big, as we've seen in a number of the deals that we've been active in. There is effectively, room for everybody, and I think the banks in particular, who are willing to effectively assess and ultimately assume construction risk, it becomes a very important source of financing for the developer as well. So I think the depth of the market is such that there are numerous projects to be looking at, certainly in the green space. So I think so far it's been really a case of working alongside these lenders. As I said at the start, we can play a very strong advisory role, and that advisory effectively becomes a role where you're helping the clients to structure these projects and ultimately get them the most competitive source of financing. And I think it's important to stress that India is a very price sensitive market, and proliferation of things like renewables has also been accompanied by significant reductions in the sorts of tariffs that have been achieved, allowing renewables to be extremely well placed to basically grow its market penetration.
Might just be worth putting a couple of numbers to the size of this opportunity. I mean, listeners who aren't familiar with India may sort of be an order of magnitude sort of out on just sort of how big the renewable opportunity is. I mean, the Indian government talks about 50 gigawatts of renewables a year. And whilst the market hasn't yet scaled up to that level, people do talk about 25 gigawatts being very achievable. And some of our early numbers in some scenarios even exceed that 50 gigawatts a year number. It's a really huge opportunity driven by both central commitments and the scale of the rising demand in India. So it's a very exciting opportunity. I wanted to drill in a bit to the shape of that from a finance point of view, because, and you're closer on the ground right now. So do correct me if I've missed something here, but it strikes me that the shape of the PPAs and the auction tariffs that we're seeing now is really important to how these might be financed. So essentially, for listeners, there was initially direct deals with state-owned discoms, not all of whom were reliable payers or indeed solvents. That was helped by underwriting by the central government through an agency called SECI, which has then issued a series of long sovereign-backed contracts for initially plain vanilla renewable contracts. But the interesting thing now that I wanted to talk to you a bit about is the emergence of complex auctions, round-the-clock shaped loads that people have to provide, whereby developers need to build a portfolio that will meet a predetermined demand shape. And obviously that's an interesting situation because it gives people a lot of surplus power to trade on the merchant market. It's one of the reasons why we think the merchant market will be a bigger and bigger part of it. But what difference is that making to the type of projects that are coming across your desk?
Yeah, I think look, I think you've highlighted quite a few sort of quite interesting points here. You talked about sort of 50 gigawatts, overlaid on all of that is this target of the best part of 500 gigawatts of installed by 2030. So it is an incredibly ambitious target, but I think one that is, in India is really something that they're capable of meeting, given the strength and the size of the developers that you see. So I think zoning in a little bit, I think you correctly pointed out that we've had a significant period where they've effectively been government-backed PPAs. These PPAs have been very, very useful because they've allowed a lot of the typical project-related risk, including what we call project-on-project risk, coming back to what I was referring to earlier, right? It's not one single project. There's a value chain here, and all the components of the value chain whether it's storage, whether it's the transmission, whether it's the solar panels themselves, or whether it's the wind turbines. All of that obviously have to come together. I think what had been very helpful in the early PPAs is that you had a good degree of commercial flexibility afforded by these. So where you had situations where there were, say, for example, there was a delay in the grid connectivity for a given project, then you would actually get automatic extensions afforded to you, by the state that is involved, or effectively where the project is located. You had provisions in there that related to things like change in law clauses that were quite helpful to cover unexpected changes in regulations that would occur. That's something that's also been very well tested in the Indian market now as well. We saw a lot of those work through some of the thermal projects. The reality is that, look, it is a complex place, in terms of doing business. But I think a lot of the steps that were taken by the government and ultimately the states meant some of these risks were actually extremely, well mitigated. Now, if we zone in a little bit on your very good question around the PPA and the shape and the development of, as you termed it, round the clock, we've had a lot of the PPAs that have been long-term and fixed price. Clearly, as this evolves now, we are getting to a situation where developers, obviously by extension lenders, are going to have to start contemplating taking on more market risk. Like you say, there will be a greater proportion of capacity that will have to be sold, on a merchant basis. Now, if we zone in on your question around the shaping of the PPA and meeting the demand profile, market risk assessment is clearly going to be key, in all of this. And the reality is that you're now in India, we're moving much more to, the term is FDRE, and that is basically firm and dispatchable renewable energy. Whereas if you took, say, a few years ago, you take a 100 megawatt solar project, that would have a capacity utilization factor requirement, but it was effectively something that would have to be met on an annual basis. Okay, so you would be measured against this. So you may have had periods where production had dipped, but you could effectively make it up, in later periods through that given contractual year. With these FDRE projects, you effectively have to supply at 15-minute intervals now. Okay, so the demand profile on these are very tailored. Okay, and do, as you already alluded to, Dan, are going to require a certain amount of excess power that ultimately will be sold, into the merchant market in order to meet those obligations that relate to that FDRE as well. So the technical challenges of all of this are only going to increase. Okay, and that's where a bank like ours is very well placed, because we do have in-house engineers, and we've basically got a set of people that can understand these things, in great detail. And the reality of moving to this kind of regime means that if you do not meet those obligations, you're into pretty onerous penalty territories as well. So this evolution has been very, very significant. Clearly, on the supply side, areas like round the clock are already playing, a significant role, because there you're obviously garnering more flexibility underpinned by a much higher capacity utilization factor, because there you're obviously combining solar, you're combining wind, and you're combining a form of storage, which in India, a lot of pumped hydro has been developed and continues to be developed, and there's actually quite a strong government policy behind that, as well as battery storage. And clearly, we're in a situation today where battery prices are going down, so we'll probably start to see more batteries, being deployed as well. So the shape of the demand curve, has effectively gone, from that sort of annual reconciliation that I was talking about, to something where there are going to be very stiff penalties if you're not able to predict, accurately what you can supply on intervals as short as 15 minutes. So I think that really does sum up, how the sector is evolving.
Yeah, it's fascinating. Actually, it's the biggest change I've noticed in the 6 months or so since I've been traveling to India is just how quickly batteries are grabbing a bit of a toehold in people's thinking about how they do these projects. I just wanted to ask you a bit about how the project finance sector might evolve with respect to those merchant revenues. Do you think lenders in India can get comfortable with lending against those merchant revenues? I mean, firstly for renewables, but perhaps also for batteries as well.
So, look, I think the reality of this, and this is something I've been well tuned in on for a very significant period of time, because we have this debate in other sectors, we have this debate in gas, we have this debate in LNG. The reality is that, for a market like India, which is growing, at a, phenomenal rate, we've obviously got economic growth, and you can sort of put a range around that of say 6 to 8%. If you look at how much demand is there today and what that's predicted to go up to over the next 15, 20 years, I mean, we're looking at 2 to 3-fold increases in terms of, the terawatt hours of electricity that's going to be, needed. So that is a little bit of a preamble to saying, I do not see sort of volume risk as being a huge issue in India, i.e., you're going to have an ability to sell the volume, right? You've got fairly liquid, traded exchanges now, and all of this is underpinned by a very unified transmission grid that has very good reach in India. I think this is where the government has done very well over the last 10 years by really accelerating the development of transmission capacity. I think off the top of my head, I think there's another 2 to 3 gigawatt that needs to be added, each year, of this capacity. And again, these things will enable those sales, right? And I think with the way the traded exchanges are working, with greater development in areas like virtual PPAs as well, you could be a producer in the north, but you could easily find a situation where the demand is not there, the demand is in the south. Well, guess what? With the structure the way it is in India, you'll actually be able to meet that demand. So that bodes very well, for the development of the merchant market, in India. I think as far as lending is concerned, these things always require very strong market analysis, market commentary as to these quite unique aspects that we see in India today. Those will have to be very well articulated. But I think there's no doubt in my mind that this will increasingly become an area, of focus. The reality is that for the smart advisors out there, there are always ways to structure such sales. You may not have, a long-term contract, but clearly you've got quite an underlying, a strong liquid market. You're going to have the ability to sell this power, and that's something that's already taken into account, in a number of the structures where you've got the ability to effectively dispatch, that excess power. So that's been a long-winded way of saying I think the volume risk is very minimal. Then you zone in on the price risk. And today in India, you guys would have been seeing it yourselves, but, you already have a very significant day-night arbitrage in India, which is actually, over 10 rupees per kilowatt hour.
Yeah.
So, are you going to be able to garner value for that gas? I think there's no doubt, that you'll be able to. So, the trick will be from the typical approach of, discounting the value, that can be afforded by the merchant sales, and making that, much, if you like, it's got to be better structured so that you don't end up in a situation where those volumes and the value associated with those volumes, too heavily discounted. So I think there is definitely a way to do that. It often, Dan, will rely as well on the strength of the developer/seller, because, as always, those folk are going to clearly need to demonstrate that they've got market access and they've got the reach, ultimately to be able to sell the electrons. But I think with that, I think there's no doubt that, this is a market that is already developing quite fast in India. And, given and look, we've got to link this back into what I said about firm and dispatchable renewable energy, right? FDRE. You have to link it to that, because the penalties for failing to meet that are so stiff. People obviously have to oversize their facilities in order to meet those requirements. So the reality is that excess power is only going to grow. So the outlets for the outlets for that power is also going to grow. So one needs to be able to make the connections there. But as hopefully you can see from what I've described, I think all the fundamental elements are quite strong in this regard.
Yeah, it's related to you're describing something that we sometimes talk about internally as a liquidity ratchet. Yeah, everyone is building oversized projects that they have to spill onto the markets. They've also got to true up at other times when they perhaps haven't got the production themselves, which means there's a ratcheting demand side as well, and so ever more liquidity enters the merchant markets. I wanted to ask a bit about the role of government, whether state or union government, and how policy can help accelerate capital deployment in renewables. Do you think it is? I'm speaking today, for example. This is the 23rd of July. We're recording this, and I'm just sort of flicking through some of the notes of the Indian budget, where there's more investment in some of these areas. Do you think there's an important role for government at state and union level, either in market design or in the deployment of infrastructure investments, in ensuring this transition happens at speed?
Yeah, I guess I already drew, upon the example of how how the transmission sector really has, to date has kept a pace, with the speed of development. Now, this is definitely a risk going forward, given the figures both you and I mentioned, 50 gigawatts of, annual capacity that the government themselves, are looking to auction, and that's increased threefold from last year, right, when it was 15 gigawatts. So I think it's already been proved, and I think we obviously had elections here recently, but continuity of policy is something that we've seen very strongly in the Indian market. And clearly, this underlying demand is not going away anytime soon. I briefly alluded to what the demand is going to be looking like in the next 10, 15 years. So look, I think government policy, I think the reality is that that's actually been the primary driver of investments, in this space. You've had a lot of incentives that the government has put in place to accelerate the deployment, of renewables. When I talk to a lot of our clients in India, they talk much more about the ease of getting some of these projects through, the sort of advent of a little bit more of one-stop shop on things like permits and consents. Obviously, the right of way on these projects. I already alluded to the transmission line support there as well. I think, again, we've got to be very clear. The government has been at the forefront of this policy push. It's very much the case in renewables, and I think we're already seeing in some of the newer areas as well, around things like green hydrogen, that is proving the case, as well. So I think what you'll see, and I think it's evidenced by the numbers in terms of what the government has invested over the last 10 years, in a lot of the infrastructure space, and a lot of that infrastructure is actually there, to enable the proliferation, to support the energy demand. So I don't see that, Dan. I don't see that fundamentally changing. I think they've put in place very strong and very measured, fiscal support, incentives. Often these incentives are kicking in once the project is operational, which is a good thing, right? Because you're creating, there's the appropriate level of carrot and stick in these things, and you're effectively creating the incentive. So I think in a nutshell, I think the support has been both clear, strong, and pretty compelling. And I think that's evidenced by the level of interest that there have been in these government-led auction processes. And elections have come and gone, but I don't see that changing in any significant way.
Yeah, fascinating. You mentioned green hydrogen. We might just take a couple of minutes as we come towards the end, just to talk a bit about that adjacent sector. But what do you see as the scale of that green hydrogen market in India? And perhaps you could just describe a bit whether you're seeing projects primarily for domestic use or exports, and what kind of size are we seeing of that opportunity here?
Sure. So look, it's definitely, something that's grabbed, our interest. I think the initial read that we have is the demand is going to be there both in terms of domestic use as well as being earmarked for export. I think in the domestic space, it's something that is going to be driven probably more by, government back. So probably SECI again, who actually have already come out with a 0.8 million ton per annum tender, a green ammonia tender. that incorporates distributed production, and the supply. This looks quite an interesting tender because it's probably going to be one of the price setters in terms of, green ammonia. In India, there is a very there's a very logical case here given how much ammonia is imported into India. So you're really looking at a strong import substitution play. There's already been a lot of interest that we've seen from a lot of our clients looking to run and participate, in these tenders. So I think fertilizer will be an obvious outlet, domestically. I think on the export side, Dan, I think what we've already seen and will likely, will continue is quite a lot of interest in Europe, quite a lot of interest in the Far East markets as well, who are obviously looking to increase the penetration of green ammonia into these markets. So you can already see a number of these companies that have bid for some of the tenders. So in Germany, for example, we've seen Indian companies bid for the Hintco tender there. Quite a few more of these are expected from some of the European markets as well. We do expect green ammonia for markets like Japan to take off as well, because I think on their side the Japanese government is sort of finalizing the mechanics of how that import will work, because the reality is today there's obviously a big price differential between green and grey ammonia for these markets, as well. So I sort of see it driven, in both ways, both domestic, and export. But I think, the import substitution play in India, underpinned by the government targets of what they want to achieve, and India is one of only a small handful of countries in Asia Pacific that actually has a very specific hydrogen strategy, and the government is already deploying. It's actually more than a couple of $1 billion, into making the sector a reality. Cost competitiveness will obviously be key, and I already alluded to the sort of development that we're seeing in Japan. But I think there's no doubt that this is something it's clearly got to overcome the sort of the key challenge of getting a strong long-term bankable offtake, right? What you'll always hear about these things, that is going to be needed given the size of investment involved, and it if it's obviously export, then it's got to be shipped, which I expect will be in the form of ammonia to those target markets. So if you look at the project-on-project risk and the associated capital expenditure, it is quite big. So developers are clearly looking to try and underwrite as much of that investment risk as possible. But I think broadly, we should be seeing both domestic and export markets, growing from the point of view of India. And I think the elements are very strong in terms of India being well placed to be a competitive supplier of the product going forward.
Yeah, fascinating. I just wanted to pull out one thing you've been doing in the market recently and see if there's a general trend here. You signed a memorandum of understanding with Renew, who for our international listeners are one of the sort of larger Indian renewable developers actually listed on the NASDAQ. And that covers renewables, storage, also hydrogen and module manufacturer. I just wondered if you could say briefly a word or two about whether you see that kind of corporate partnership as the natural way to help finance and develop adjacent technologies like hydrogen, or whether this is just one of a number of approaches you might take to support hydrogen projects in India.
Yeah. So I think, the story, the evolution story behind Renew is a very, impressive one. It's a company that, just in the space of a little over 10 years has managed to develop and successfully deploy, very material levels of, renewable capacity above 10 gigawatts. The pipeline for them is also, very, very strong. They've taken a very strong lead in some of these areas that are developing, like round the clock power. And that was actually one of the round the clock project that we did with Renew last year. That's the first one globally, as I understand, that has ever been, financed. And clearly, when you look at a company like Renew, they're obviously focused on developing as much capacity, but effectively making, the cost of the green electron, if I can call it that, as competitive as possible, because that will make it, that will be a key enabler, of course, for areas like sort of green hydrogen. So there is an adjacency, coming back to your question, that we do see with companies like Renew, who will be there to ensure that these projects can be facilitated. If you've got the production side in terms of the green energy, in a very strong state in terms of competitiveness, and then you've got the reliability and the very high utilization that you can achieve by deploying things like round-the-clock power at scale. These are all very good elements, Dan. So very much an adjacency. Clearly you're looking at sort of, if you like, different commercialization routes for the green power. This is going to be a very important one, given the climate emergency, of course, that we're facing globally. And I think Renew have firmly put all of their weight behind this. They're a very impressive company in terms of the amount of in-house capability that they have cultivated over these years. And I think I didn't really touch on it earlier, but the whole notion around make in India and developing more local supply and manufacturing capability, what has been termed by people as sort of China plus one. This is all clearly at play. And what is also very impressive about a company like Renew is they control the bulk of the value chain cost by effectively having this integration. And what I like to call backward integration is effectively what they've applied here. So that does put you in a if you develop this in-house expertise and capability, that clearly does put you in a very strong position to control costs and ultimately deliver projects on schedule. And I think for that they've had an absolutely outstanding track record, and that's one of the many reasons that we're very proud to support them.
Brilliant. That's been an absolutely fascinating conversation. I think we range pretty widely on that. I'm going to be really looking forward to working with you more as all of these parts of the energy transition ramp up at pace. But thank you very much for joining us on today's podcast, Katan. It's been absolutely brilliant.
Thank you, Dan.
That was Dan Monzani, Aurora's Managing Director with responsibility for the new service in India, talking to Katan Hirachand, Chief Executive and Chief Country Officer of Société Générale, India. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.